Russia has done two interesting things recently. Their central bank has said that they're going to add silver to their reserves for the first time, in addition to gold, platinum, and palladium. And the Russian government, back in late November, said that they were going to ban the export of waste and scrap precious metals. So bottom line is, where's the opportunity? And if you look at the silver market, we know we have rising industrial demand. Industrial demand was about 50% just 5 years ago. Now it's moved up to 60% of the market of consumption of the supply. Investment demand, we know, ebbs and flows, but when it flows, it really comes back, roaring back, and that really is kind of the wild card that helps to cause these big run-ups and spikes in the silver price. As you can see, I'm going to be talking about silver today, and some really interesting developments. I'm going to get to that a little bit later in the talk. But first, I'll do a little bit of macroeconomics and talk about why things are really pretty exciting on that side and how that's going to help to push the silver bull a lot higher. We're approaching something I call the Minsky moment. And so Minsky was an economics professor in the US at some larger universities. And he had something called a financial instability hypothesis. And really that's what he was saying was that financial crises are really not that abnormal. They're in fact quite normal, and they're to be expected. And someone else actually ended up coining the term Minsky moment. And really the bottom line of it was that he was saying that crashes come from excessive debt, which builds up and ultimately leads to instability and eventually a crash. So let's look at where we are now. Global debt, and this is at the beginning of 2024, it was at $315 trillion. Obviously a record. I can't even imagine, how much higher we are now after another year of this kind of action. But that's certainly the kind of setup that Minsky is talking about. The global money supply, that actually, as we can see, that popped in the wake of COVID and then drew back down. Central banks, when they saw inflation, started to raise rates, and all the stimulus started to dial back a little bit. And we had a couple of years of sideways movement, and now we've seen that really start to pick up again. So just last year, we saw $7.3 trillion of new money coming into the world. And this is starting to trickle down into the main street, the average investor's minds. This is a chart of the 10-year yield, and we've seen it really start to break out in a very meaningful way now. And this goes back to the 80s or so. Just since March of 22, we've had the third occurrence of a 10-year yield breakout under similar circumstances. That hasn't happened since the 1970s, and we certainly know what happened in the 1970s. And really, it's signaling a shift in the bond markets and inflation and the perception of the likeliness of inflation sticking around. And so if you look at what happened, just one of the last times that this happened, in August of 2023, you had this spike in the 10-year yields. The S&P was down by 10%. So really, higher yields, as you can imagine, they compete with stocks. There's opportunity cost. People will ask themselves, why do I need to take risk in stocks when I can be in bonds, sovereign bonds? We don't need to argue about the security of sovereign bonds, but at least if it's in relatively short term and yields are spiking, and there's certainly an argument to be made for bonds versus stocks. Now, talking about inflation and parallels with the 1970s. So this chart, there are different scales on the two sides. One is the 70s and the other is the 2020s. But this lays the two periods one over the other, and it's incredible how much they've followed. So this current wave of when in July of 2022, we peaked at 9% inflation, that was similar to the second wave, which was in the mid-1970s. And the interesting part is that, as you can see, we're getting close to potential bottom now. And I've been saying for a couple of quarters that we're very likely to see a bottom, I think, sometime this year, and inflation is going to start to creep up again. So if you think you're not happy with inflation now, enjoy what you've got, because I think it's going to get worse. The average person is really starting to accept, I think, that inflation is here, it's baked in, and it's going to continue. This is quite a dramatic change in the mindset of consumers. The Americans now expect, on average, for the next 5 to 10 years, for inflation to be at a 3.3% annually. So again, not something that we're used to, but people are really starting to believe, given the behavior of the last 3-4 years, that this is something that's not going away. And this is very interesting. So this chart shows you the top line is the increase in 10-year yields. The red line is the Fed funds rate. This is absolutely abnormal. When the Fed cuts, normally bond yields will fall. So if you think about the kind of environment, the Fed's cutting, it's because the economy has weakened. It's because they had been prior raising rates, causing things to cool down a little bit, and then eventually, playing God and starting to raise rates again, starting to cut rates again to help to stimulate the economy after it has slowed down. Lenders would normally do the same. So they'll see that the economy has slowed and they're going to start cutting their rates in order to stimulate lending once again. This is not what the long-term, the longer end of the bond market is telling us. So for the first time ever, we've had a 100 basis point cut from the Fed being matched by a 100 basis point gain in the 10-year yield. And that really is the market telling us that it thinks that the Fed was wrong. It did not need to start cutting. It was too soon if it needed to cut at all, and that it's essentially juicing the economy at a time that it doesn't need this kind of stimulus. And so that's really the bond market telling us that it's expecting inflation to come back and for rates to go back higher again. This is really what the Fed's dilemma is. They can either stop cutting, that will help fight inflation. If they were to even keep rates where they are right now, I'm not going to say high, but let's say on a relative basis, a little bit elevated. But that's really going to cause struggle for the government that has record outstanding debts. It's tough for Wall Street. It's tough for Main Street. Or you'll see the Fed continue to cut. Maybe not immediately, but I think that they would continue to cut. That will help the government, which has, as I say, record debt and deficit levels. They need to actually refinance a lot of this debt, especially this year. I think it's something like $10 trillion this year alone in the U.S. And then by cutting, they also help Main Street, they help Wall Street, and they also give themselves the opportunity, perhaps at some point again, to start raising rates. I think that the path of least resistance is the second option, and I think that we can pretty much expect that to continue, again, as I say, if not immediately, likely to come over the next few quarters. This is just a little thing I wanted to point out. It's not just consumers that are starting to worry about inflation, but shareholders. So this is just a couple of months, a month back or so, there was a proposal for, and I have their Amazon, but it was also proposed for Microsoft shareholders that they wanted to consider Bitcoin as an asset for their treasury. Now, we all know that Bitcoin's quite volatile, but the aspect of a hard cap on the number of Bitcoins to be produced is seen by the market as a form of hard money. So the National Center for Public Policy Research, I'm just going to read this off, in that proposal said to Amazon shareholders voting, they were saying, during inflationary times, corporations have a fiduciary duty to maximize shareholder value, not only by working to increase profits, but also working to protect those profits from debasement. And I wrote a book I published a couple of years ago called The Great Silver Bull, and I said essentially almost 3 years ago the same thing. I said companies one day may be challenged by their shareholders for holding too much cash as it loses purchasing power, hurting share values. So we're actually starting to see that play out in a real way. So bottom line is, where's the opportunity? And if you look at the silver market, we know we have rising industrial demand. Industrial demand was about 50% just 5 years ago. Now it's moved up to 60% of the market of consumption of the supply. Investment demand, we know, ebbs and flows, but when it flows, it really comes back, roaring back, and that really is kind of the wild card that helps to cause these big run-ups and spikes in the silver price. And we also know that we have limited supply in the silver market, and that is likely to lead to more silver squeezes in the future. So you put that all together and you have the ingredients for a strong silver bull market. On the fundamental side, we know that demand outstrips supply. These are numbers from the Silver Institute. Those 4 bars, downward bars, are the last 4 years of deficit. They expect that these deficits are going to continue for years going forward. They actually think that at some point in the next 5 years, we're going to reach a new record deficit in the silver market. We've seen that silver demand from solar has been growing. The big sort of huge growth years were 2021, 2022, 3, 4. It looks like it's slowing a little bit. I wouldn't necessarily argue with this because I do think the demand's going to continue to grow. I just think that it's not going to be at such an aggressive pace, but it's still going to grow, meaning more demand for silver coming from solar. I say that, but on the other hand, if you look at what's happened in terms of estimates by the analysts, if you go back to 2010, on average, the estimates looking 5 years out were underestimates for solar installations were underestimated by 3 times. So solar installations were 3 times higher on average what analysts expected going 5 years out. So that's why I think we've seen solar really become the single biggest industrial consumer of silver today. And then other things that are coming down the pipe are things like data centers. We've seen the growth in data, storing data, processing data has really just gone through the roof. AI is adding another dimension to this. And the data center operators, we're talking big companies like Amazon, Microsoft, and Meta, and so on, they're actually plowing a lot of their own money into being completely independent, not relying on